all this is, it's just more proof of us being exactly where we think we are in our economic cycle, and that it's time for a little shift. The job report is one of the key indicators of how our economy is doing. Well, the job report for July just came in and it was not good. It was well below expectations. And with job growth being so much smaller than was initially anticipated, there is a fear going on right now of a broader economic slowdown. So let's deep dive into this. And before we get started, let me just say that if you like content like this, leave a comment down below letting me know what you think. Make sure you subscribe for more content like this and hit that thumbs up button for me. So the job report data for July just came in and it was underwhelming. Non-farm payroll came in at 114,000 compared to 185,000 estimated, and unemployment ticked up to 4.3%, which is its highest number in almost 3 years. And there's a fear of a recession right now because mostly that unemployment number, but also the slowdown as well. There's some rule out there that I think the SAM rule or something, you take the last 12 months and compare it to, and and all that. We don't have to complicate the economy like that. You might see reports and articles about the SAM report, and while it is true, and sometimes those are indicators for where the economy is heading, and right now it's kind of flashing red for recession, but just know that we don't have to overcomplicate it. The numbers are bad. Not enough jobs were added, as many as we thought would be added. More people are losing their job than we thought should be losing their job. We never want to see that number go up. And basically what it comes down to is, with these higher interest rates, with how much borrowing, how much it costs to borrow, companies are spending less money. Companies are being more frugal. Companies are not borrowing as much to grow as much because of the economic conditions that we are in. Now, that's an oversimplification. Consumer spending and what type of industry you're in is going to play a big role in all of this. And if you're looking for a job right now, some industries that had pretty good growth. Healthcare was the leader. Construction did good. Warehousing did good. But overall, and while jobs were added, it's not to the degree that we were expecting. Then more important than even the number of jobs that were added, unemployment going from 4.1, which was a shock the last time that we talked about it, 4.3 again, an even bigger indicator that the economy is slowing down and it's getting harder for companies. And the stock market did not take too kindly to the job report, but just know this was the same stock market that took very kindly to the Fed saying that they were, not saying, but basically saying how they're going to be cutting rates soon. And these market fluctuations based off of reports and what's earnings and things like that, these are all healthy market things. Now, I'm not giving you financial advice and saying to sell or buy, and you might see a whole bunch of clickbait stuff online and this is the end and you need to do that. Just know these are all healthy market things. The market is supposed to react to the job report. When Apple and Google and Microsoft do their earnings, the stock market is supposed to react to that type of stuff. That is where the money gets made. And just like a couple days ago, it reacted very nice to some stuff. Job report came in very underwhelming. It wasn't just a little underwhelming. It did not look good. And the stock market responded accordingly, but it's not like a huge, shocking, scary type of thing. These are all normal things that play out regularly. And the Fed will obviously look into the job report in pretty good detail, a lot more detail than we might be discussing in this video. There is the unemployment number. There's also a short-term unemployment number, a long-term unemployment number of people that have been unemployed a certain amount of months. And, it does get pretty detailed, and the Fed will be looking at those details, which they should be doing, and which in all honesty, I do as well. I just don't necessarily discuss it in that great of detail in the videos. I just kind of give a broader view because it doesn't have to, but they will be looking at those nook and crannies. And in all honesty, the nook and crannies are saying that, there is a fear of a broader economic slowdown if we stay on the path that we are on. But the Fed has obviously made it clear that we won't be staying on this path. We will be cutting, but I don't think that this job report will change the rate at which they cut. I don't think they'll do an emergency cut before September. I think that they will stay on the course. I think this is further proof or evidence of what they are saying they probably will do, that they should do. And I think that that 0.25 cut is going to come in September. I don't think that this warrants it to go any higher than that, a 0.5 cut or anything like that. And I don't think that it warrants it to come sooner. I think that in September they will cut rates, and some of these numbers, they might start to shift with a rate cut, but the job report just kind of more evidence and more proof that a little shift in monetary policy to keep the ship afloat is kind of where we are headed. Now, again, I could be completely wrong. They could cut it by 0.5% or something. It's their decision, but just me looking at it from my own perspective, I think that all this it's just more proof of us being exactly where we think we are in our economic cycle, and that it's time for a little shift. If you like content like this, leave a comment down below letting me know what you think. Make sure you subscribe for more content like this and hit that thumbs up button for me.